Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, July 7th, 2021. It's about quarter to 1 Eastern Time as I'm starting the video, and here's what we're going to talk on. We'll do a very brief update on the broad markets, the major stock indexes, small and large caps. Then we'll look at Treasury bonds. I just want to point out what's going on the Treasury bond market, anything it might be telling us, and that'll be a very brief overview. And then updates on some of the trades I've been highlighting recently, some of my favorites like lumber, crude oil. With that, I want to talk on the energy stocks. That's XLE, XOP, and XES. Those are your main energy sector ETFs. And nat gas, I noticed a setup there last night, and I think it's still an active or an objective trade entry on natural gas here. So I'm going to go over that real quick. Maybe touch on airlines, what's going on there, and then my sector du jour, XRT, the retail sector ETF. I think there's a big trade coming up there as well. So that's it. Let's dive into the charts. Starting out here, this is the NASDAQ 100 futures NQ. This is a 60-minute chart right here up at the top. It says hourly candles, just in case I don't mention what I'm, what time frame I'm on. And we're still watching this primary trend line here with this little minor trend line. The minor trend line, a break of that should bring us down to the more significant primary trend line on the 60-minute chart. And if and when that breaks, you can see some targets down here. And at this point in time, at minimum, I think we come back to the 1466 level when we get that sell signal. Now, that's what we need to get, a decent sell signal. And let's look at the S&P 500. We broke this minor trend line here. So it's, again, not a hard sell signal on the indexes now. They're grinding higher. They've been resilient as I've ever seen them be. What does that mean? Well, they played out well to the technicals, but a lot of times they'll shrug these divergences off for quite some time before they finally succumb to the divergences. And then when you do, lately the corrections have been relatively minor, but just don't forget, divergences continue to build on the daily chart. We're starting to see cracks. I had the financials break down recently. They're still in a sell signal. I have airline stocks breaking down recently, and some other sectors. We'll go over some of that here. All right, so where do we go from here right now? Again, there's better fish to fry than the indexes, no doubt. The volatility's been low. There's just not a lot of meat on a bone of whether you're long or short the indexes lately. And being the fact we have all these divergences and overbought readings we're coming off of here on the 60-minute chart of S&P 500 futures, the next move, the next tradable trend will most likely be to the downside. So watch this trend line. We only have 3 reactions on it, but that should do the trick for this divergent high right here to play out just like this one did. That one played out for a tradable correction there. And that's what it looks like on the S&P 500. Small caps already broke down recently. They put in a divergent high. This is RTY, Russell 2000 futures, hourly candles as well. And you put in a divergent high right here. You had divergence there, and then you put in 3 equal highs while the indicators kept that negative divergence in place, and has started to play out for a correction so far. You can see as I'm drawing out there, that was my first target and support about 22.99 or so. Bounced off that, hit it again, and as mentioned the other day, solid break below that should open the door for a move to my next target, which was hit right here, 22.61. There it was, boom, hit, a little bear flag action, another thrust down, and as I do the video right now, it is an objective short entry because we're bounced back to that 22.61.50-ish support right there, and that's how it works. Support once broken becomes resistance, so you could throw a shot there. Now, again, better fish to fry. I just tell you, I'm not taking this trade right now. You also put in positive divergence here on the 60-minute chart when you had that recent low right there. There's your divergence, and so I just wanted to point out, now if there's more downside to come. Sometimes these divergences don't play out, they get burned through. Either way, I wanted to give you the levels. If the divergences do play out and you want to go long the small caps, you already did, well, that would be the next target up there, that 22.9870 level. Let's talk Treasury bonds real quick because they're somewhat related to the stock market. This is TLT, the 30-year Treasury bond ETF, 20 to 30-year bonds. Back here I was bullish on Treasuries, laid that out as a long trade idea on both ZB, the Treasury bond futures, as well as TLT. Broke out, back tested, and we've been moving higher since. This trade kind of getting a little stale right here. We consolidated for a while under that 140.69 resistance right there, but then we broke out, and treasuries have been moving sharply higher. That is often a red flag for the equity markets. You can do this. You can say edit chart properties, add, compare the S&P 500, and you can see, for example, back here I pointed out this symmetrical triangle breakout, and Treasury started to rally. That's the candlesticks. The purple line I just overlaid is the S&P 500, and you can see it there. When I turn off all the lines, that might make it easier on the video. There was our triangle right here. We had the breakout. Treasury started to rally, and it was a red flag. Now, once they broke out, was right here. The S&P had a little blip, but went up, made a marginal new high, and then the bottom fell out. And the Treasury bond market is usually a good indicator for what may happen in the stock market. Typically, it's your smart money, institutional traders, those in the know that are trading treasury bonds. And so when the institutions start buying treasuries, that is often in advance as they're exiting the stock market or hedging up their equity positions because they're concerned. It is a risk-off asset. Stocks are risk-on. And so there was the tell right there, and then boom, the big drop came during the COVID lows, so not by coincidence. And so what we're seeing here is the same thing. Stocks and bonds are usually inversely correlated, especially treasury bonds and stocks, meaning one goes up, that's the treasury bonds going up, and stocks are falling, and vice versa. That's an inverse correlation. Inverse. However, where you want to pay attention to is when they start moving together. This is a stock market going up. This drop here in Treasury saying, okay, risk off or risk on. It's safe to be in stocks right now. Economic indicators are strong. Retail sales, job numbers were increasing. The vaccines were working, and so the stock market was rising and bonds were falling. But as of late, and again, it was priced into the charts, but now we're seeing a sort of a increase in the rate of ascent right here in treasury bonds with the stock market making new highs. That is it's not divergence, it's positive correlation. What it is divergence between yields. That's what you want to look at, and that's TYX is the 30-year treasury bond yield. So there it is. Bond yields are falling because prices are going up and the stock market's rising, and often when that happens, that is a kind of a red flag, if you will, in the market, just like there and there. Before the big drop in equities. So I wanted to point that out for you. And I won't go over each and every one. Just say it's the same on 10-year bond. You want to watch the 10-year as well. TNX, this is a 10-year treasury bond yield. Remember, bond prices go inversely to yield. So you can see these divergences here. And again, it's something to look out for. Typically, you want to see the yields in the stock market are usually positively correlated. And then the bond prices in the stock market are inversely correlated. And here's this is lumber futures LB. As I've said many times, if there was an ETF or an ETN that directly tracked lumber futures, I would be giving you a chart of that, because I know a lot of you guys don't trade futures, and those that do, it's a big contract. Lumber futures is about each contract represents about $91,000 of your capital exposed. So you have to do the math on that. If you take it, this thing goes up and down. On a big day, it's up down 5%. So you have to do the math on that. 5% of 90,000 is going to be, close to $5,000 a swing. So it's all relative to your position size. If you're trading an account $1 million plus, no big deal. You can trade lumber futures. If not, and wood and cut. And if anybody knows of one, these ETF and ETN companies are constantly coming out with new products. There's been a lot of hype on lumber. Maybe there's one out there. Just drop a note in the comment section. If you did and I missed it, my apologies. But I'm going to highlight this only because I like it. And there's our downtrend line breakout right there. We went up just earlier today. We hit T1 almost to the button there. and pulled back as expected, but I showed you on the arrows, and I mentioned too yesterday that I expect any reaction there to be minor or fleeting, and that's so far what it was. We had a pullback on the initial kiss of T1 this morning, and we're right back up to it. And so that remains resistance. And the way it works is 855 and change is resistance. You always want to sell a hair below these resistance levels, whichever, if you're targeting that level. You might be holding out for T3, that 50+% gain, if you hit it. And if so, then you ride out the little squiggles. If you're an active trader, you could have sidestepped that and saved a few $1,000s on the give back right there, probably 3-4 grand, and recycled back in on the pullback. That's all I expect, a minor, and or I say and or because you can do both if you're trading multiple lots, and buy a breakout above 855, and that should open the door for a move up to T2 there. About 934.70 is where I have the line. Maybe sell a hair below that. That's the next resistance. And ultimately we may carry up here to T3. And just to loop over to the chart of lumber futures, the daily chart, which we're looking at here. Again, time and time has been covered a lot. Lumber tends to go in these parabolic trends like this, and when it does go in those parabolic trends, once the parabolic trend line breaks, you typically have corrections. I know there's a lot of lines on this chart, and you probably can't see them all, but I'm just going to tell you from here to here. I measured it out, and I've gone over this. That was a 56% drop to the lows right here. Once we broke this parabolic trend line, that ended with a divergent low, big rally to the upside. There was another breakdown right here, trend line from top to bottom. Lumber fell about 44%. Here was a parabolic trend line break. Lumber dropped 47% rounded off right there, and so far this time around we fell 60%. It was a bigger rip, and hence a little bigger dip on the downside. Cannot rule out another thrust down here, but as of now, looking good so far. Remember, we backfilled this gap. This was sort of my my buy-in range recently. I'm trying to box it in or circle it in. We had a series of gaps in here, and so really from about this level down to about this line, with an ideal target of that backfill there, 700. So far we bounced, and so it's been a nice trade. And there were other factors that go into why I'm think we'll get a good chance we'll run up to at least that T3 level. Oversold, and I've gone over that again. Last time we were oversold here, and this is when you want to be buying lumber. When you're oversold on the other side, and I've measured all the rallies right here from those, and even during a downtrend, your rallies are usually well into the double digits when you're oversold. This one was actually off that bottom about a 95% run. And sort of a side note before I move on from lumber and get to the next chart, the longer the stock market holds up, the better the odds are we're going to hit that T3. I'm still at minimum. I'm looking for a move up to that T2. Of course, we have to break out for today's highs, which was T1. That's resistance. And if the market were to crater and start to really give me some pretty hard sell signals or moving down impulsively, I'm talking the broad market, economic growth expectations would be shifting, and that could affect lumber prices. You probably see a few people that were planning on building a new house, putting the brakes on there. The housing market cools off with the stock market. So just keep in mind, my targets and price charts and analysis is dynamic, constantly changing because the markets and the charts are constantly changing. So if and when my outlook changes on lumber, I'll let you know. But as of now, I'm still think there's a good shot we can run up to that T3, and a very good shot we'll hit T2, and all we have to do is just move a little bit higher. We're almost at today's highs as I'm doing the video. So, and remember, this chart here is an end-of-day chart. When I go to this one on stock charts, these white charts, they populate or update the data, a couple hours or an hour or two after the market closes. So it's not reflecting today's move. Okay, and while we're on these longer term charts, This is a daily chart. The previous one, yeah, that was daily also on lumber. This is crude. I'm going to cover crude oil now. We'll look at some shorter term charts next, but this is WTIC. That's West Texas Intermediate crude. Same as the crude futures we're trading, CL. They just use this symbol here. And this is a chart going back to 2017, about the summer of 2017. So we have several years on here. And this was a target recently highlighted right here. We have a major reaction high back there in 2018, and you can see we had negative divergence going in, and then we had a correction. It was a big correction. We're at about $75 a barrel right now. We dropped down to 42. That was a nice trade right there, and that ended with positive divergence. So this is kind of bigger picture stuff. Watch, rinse, repeat, and I've been saying now for a few weeks there'll probably be a big trade coming up on crude, just like I for weeks was warning that with lumber prices when they were going parabolic. Said you're going to have a big trend trade coming up, a big short on lumber, and it did. It fell 60%. Now crude's going to do the same soon, I believe, based on the charts here. There's a big drop, divergent low. You want to get long. Went up here, resistance. We put in, traded sideways for better part of almost a year, 9 months or so there. Put in an equal or maybe a marginal new high with negative divergence and then the big drop. So it's not, what happened was COVID a black swan event? Yes. But was a big drop, was a drop priced into crude? Yeah. Was it that much priced in? No. Things happen. Crude actually went negative. It's not reflected here because on this end of day chart, but that was a big drop, when pretty much everything shut down. And you can see that low came with strong positive divergence. So watch, rinse, repeat. Next divergent high was right here. There was a correction. Again, this is log scaling, so it might look like that wasn't a big drop, but it was. It was about $44 down to about $32. That's a big drop in crude, about 25% or so right there. And there's, we've come full circle. Oh, that, by the way, had positive divergence. Don't know why it's not marked here. There's your positive divergence. That led to this run up, which now has hit that major reaction high, long-term resistance right there, almost to the button. So there it is. And this divergence is large. It is about in sync. If you look at the timing, the spacing between these corrections right here, they're fairly regular, and that's it. So I think crude is at or near the end of the run. You can't really use this. You can use a daily chart. It helps formulate the bigger picture, but you want to time your entries and exits with, I like to at least, with a 60-minute chart. And here's the one I've been highlighting for quite a while now. We've been, moving up. There's little swing trades to be had here. Divergent high, correction, negative divergence, correction, negative divergence, little correction. But this divergent high, we kind of reset the divergences here. So this point we started new divergence, and it's only continued to build up to this point. So really this is our divergent high right now, our most recent one. And we broke that minor trend line the other day, impulsive leg down, little snapback rally, hit my first target, snap back, and we're just below it now. Resist or support once broken becomes resistance, so therefore you have an objective long entry here at about 72.50 on that kickback to T1 for a ride down to T2 next, 70.48. Again, actual resistance levels. You can use SCO, as I mentioned, is a inverse, two-time inverse crude ETN if you don't trade futures, and if the CL is too big of a contract for you, the contract size wise, QM, I believe that's Q is in Q-tip or Quebec, and then M is in Mary. That is the mini, M-I-N-Y they call it, contract. Trades off these same prices, you just have a much smaller leverage factor, and that gives you my targets there. I think there's a very good chance we come down here to at least this T3, that's 66.61, and from where we're at now, let me draw that line there so I don't move everything, move it back up. You're talking about an 8%, almost 8% drop to get down to that T3 target, and of course obviously a little less to T2. And then the big takeaway is if we start to see the stock market rollover, some economic indicators, more weakness in the financials, other things that help build the case that this market may have topped out for the time being and we may be looking at a bigger correction, then don't underestimate how much crude could fall. So I'm showing you near-term targets here on a 60-minute time frame, but on that longer-term chart, you may be able to ride down or tuck away a short on crude for quite some time. And if you do that, then just use stops wherever you want. A little bit above the highs, you can put a little bit above your entry. Everybody's different, so I can't give you one. There's not a one-size-fits-all stop. It's commensurate with your entry price, or in line, or dependent, I should say, on your entry price as well as your price target or price targets, or even entry prices. Some people will scale into a position. That's what I'll often do on long-term positions on things like commodities and in stocks or whatever I'm trading. All right, let's move on to the next one. So that's it. It either works or doesn't. Objective short entry, your stops can be tight. They can be above that previous reaction high, or they can be above the last reaction high right there, or previous reaction high, the big one. And I'm going to get to the energy sectors, but while I'm on these futures charts, let me just show you NG. So this is one that I noticed last night after I was going over the charts. We had a little uptrend line there, but it broke, but it didn't do the trick. We went on, made a near back test, but what happened since is we put a nice divergent high right there, and then we had this support level here at 360-ish, just as well. I was going to throw it out late last night, and I'm like, what, I can wait till tomorrow to post that. It broke down today, but you know what? It broke down. It was going so fast, you probably would have, missed an entry right when it broke down because it was impulsive. And now we're back testing, so we're right about where you probably would have shorted had you had an alert set at under 360, and that's again NG natural gas futures. UNG is one of the natural gas ETNs that you can short. I don't know if DGAS is still around. Some of those Crude and other ETNs that track commodities and use leverage, they kind of blew up last year. I'd have to look into that. There is a mini contract or a micro contract for natural gas. I'm just drawing. I had to update this chart recently, so a lot of my lines went away from the other one. But QG, I believe, you want to double check that. QG, I believe, is the contract, the mini natural gas contract. There was a little wedge in there. What I'm doing, I'm just marking this chart up because I hadn't done so and giving you targets. So I'm doing this now. Probably put one about right there. These are support levels. So almost three, we'll call it 340, 328 or so, and ultimately maybe all the way back down here to 292 or so, and that again is NG natural gas futures. Since I'm flipping over to these longer term charts, like I did on lumber and crude, I'll just hit this one on natural gas. I pointed out natural gas back here, and that was a year ago in 2020. Right here, there's a couple things on this chart. If you can make out these blue lines at regular intervals, these are called cycle lines. And I noticed a pattern, which I highlighted back then, about looks like every July, end of July, August, these arrows show each time. Again, the cycle lines are evenly spaced, 1 year intervals, and you can see all these arrows showed major inflection points. When you do cycle lines, sometimes you'll have to shift them. Most recently they were right on. You can see if you bought these dips at that time of year, in most cases, not always, but in most cases there was a rally that came almost immediately. And if we went sideways, you didn't go much underwater, and then there was a rally to be, trade to be made. A few times it didn't happen. And then back here you just shift. Sometimes the lines have to be shifted. Back there it looks like it was maybe about August, maybe mid-August or so, but pretty reliable. Now I haven't extended these lines. I could do it. I could tell you one would be right about here-ish if I did it. Now the thing is, these cycle lines catch, maybe it's a little over here, they catch bottoms. We've been in an uptrend, so even though that cycle line comes here, it doesn't come into play. We may get an inflection point, and more importantly, since that last buy signal there for a longer term trade, you have resistance. I've had this resistance line here right about where we hit, right about 360 or so today. I've had it for a while. So I just wanted to point out that that helps the case because I see a lot of reactions on this line here. And so that's it. So we have natural gas running into resistance, number one, while overbought. That 60-minute chart, I just made the case for a short, and see what you have here, negative divergence. Voila. So last time you had divergent high on the daily, at least the way I have it marked, was right here. And that's it. So there's a case for a short on natural gas. Wouldn't be an all-in heavy short for me because I'm bullish, longer-term bullish on commodities. I believe natural gas may have put in a, lasting bottom here. Needs to take out this high to help say that we're in a new bull market, because so far, if you look at it this way, the overall trend has been bearish. Unlike a lot of other commodities which have already taken out their previous highs, crude oil, lumber, all the grains and everything else. So that's why I wouldn't, just use stops. I'm looking for right now a pullback trade, a tactical trade, shorter term trade, not a, strategic or long term trade, because ultimately I do think crude will work natural gas will work its way up there. Okay, now that all will segue now into the energy sector ETFs, because they're going to hold companies that profit from both the crude and natural gas. And so that's XLE number one. So I made the case, and crude's going to affect these companies more than natural gas. So I made the case that I think we may be at a major top in crude oil, at or very near that. And if so, then the energy sector is going to provide a nice short trade, swing or trend short trade. And what you have here, you've had divergences building. You had negative divergence at this point. I'm sorry if I didn't mention it. It's right here. I think you can see the symbols XLE. This is your major energy sector ETF, big oil. And this is a daily chart on XLE. So you had divergence there. That was resistance right there. I talked about at the time, to me, big resistance. I laid it out as a short trade right here on a break of that wedge, break again. We did. We got the pullback. Ran up there again. We took out that 53.61 resistance, but marginally, and we failed it. So what you have here is a false breakout so far, aka bull trap, and we're moved back down below it. Not by a lot. I think when we take out this little line down below, that'll do the trick. So we're right at support now. And if crude does roll over, as I suspect, I think the energy stocks will come back in. And again, it's these divergences. Remember, we had divergence right here at this high, and we did get a correction. We pushed on up to make a marginal new high, but we only extended those divergences. So now we have a much larger divergent high, which sets the stage for a much larger correction ultimately. That's XLE. XOP, you get a little more bang for your buck. This is the oil and gas exploration and production ETF. There's your negative divergence. Again, we had a divergent high here, and that divergence has only grown larger at this point. We also have some resistance there, previous reaction high back there, and targets at least 72.70 right there. That would be my minimum pullback target, if not more than that. We'll see. Let's just see how things get going here with crude. XES, same story. This is your equipment and services, oil and gas equipment and services ETF. So you had that divergent high right here, nice little beautiful bearish rising wedge. It was pointed out there at really nice resistance back then. All these support levels became resistance. So we had a short trade I highlighted there, went down, hit that 45.75 target, and reversed, made a marginal new high, which only extended the divergences. So therefore, we'll probably come back in and come back to that 45.75 level again, and ultimately probably down here to 39.74. And that would give you a drop from where we're at today of about 32-33%. So there's some trade ideas for you as well. Maybe layer into these, or continue to monitor crude, or hard short. Sometimes I'll do a hard short and just set a stop above. It's either going to work out or not. It's all about risk reward. If you're shooting for a 34% return, you can use a 10, even 11% stop loss. You have a good 3-to-1 risk reward ratio. And like anything else, it's going to work out or not. If it works out, you make 34%. If it doesn't work out, you lose 11, you move on to the next one, and you do that often enough, and you don't even have to bat 500. You can have a 50% win-lose ratio, and you're still going to make money using that favorable risk-reward ratio. Risking $1 to make 3. Okay, it's getting a little long. I'll just touch on that. I won't go over the individual airlines, just to mention that there's that what is it that there's a couple new variants of COVID that people are worried about right now, and we may see a lot of cancellations on flights and all that, is what I'm hearing. Big resistance. Forget about what you think may or may not happen with COVID and air travel and all that. All I can tell you is that 112.51 is a big level for the airline sector. Major highs for years now, and we failed there, and we had negative divergence at the time, and we broke the uptrend line, and almost all the airlines I track have also broken their primary trend lines. Just about all of them, put in negative divergence at the recent highs, and here's a pretty good support level, about 89.52. So I think there's some more downside in the airlines near term. I wouldn't short them now. I probably should have thrown those. I might have thrown them out a few weeks ago. I can't recall. I was covering a lot of different things, but they're getting oversold. I do think there's more downside, but it's about risk reward. And again, I'll go over the individual airlines in a different video. Before we wrap this up, I just wanted to touch on XRT. Let's see here. Okay, video's still going. I thought I might have hit the wrong button and stopped the video. XRT I want to look at real quick, and then we will wrap the video up. XRT is the Spiders S&P 500 or S&P Retail ETF. Here's my trend line. Not super crazy about it. There's an uptrend line that I have right there, but I think it's probably going to do the trick. This one's getting long in the tooth. We also have a minor trend line right here. Let me try to put on a better color there for you. And most importantly, this divergence right here. We had extreme overbought conditions right here, and you can see strong negative divergence. Again, the retail sector. And take a look at this. I'm going to roll back. As I roll back in time here, we'll even go to a weekly chart. This is a weekly chart. We're going back now to the entire bull market. Here's the beginning of the bull market for retail back in late 08. The stock market itself, bottom in March of 09. And look at this. Okay, there's a disconnect here. Okay, COVID hit. I get it. Everything dropped, shut down, spending. But should these retail stocks, as retail, have profits grown to this point where we broke out? It was a multi-year trading range. Got to give it that. And that's powerful stuff, and you broke out. But look how far above we are that range. Since we broke above the top of the range at about 55.34, retail has rallied, what is that, 86%? So to say that these stocks are overbought would be a gross understatement. They became extremely overbought here. And again, you have the divergence I showed you. So bottom line is there is a lot of hot air, and more hot air in this sector than a lot of others that I'm seeing recently. What would be a target? I think we could come all the way back to test the top of that range ultimately, even if we're in a new super secular bull market with more highs to come. It's quite possible we can come back down to earth, and check that level again. Which again, I'm not talking the COVID lows from March to. I'm talking those multi-year highs right there, and that would be a heck of a drop. So how to capitalize on it? I don't want to go too long in the video because we hit the 32-minute mark just now. So what I'm going to show you is the trade idea that I would use. And I would also say this, there are a lot of individual retail stocks that I like better on the short side, some better than others. And time permitting, I'll do that in a separate video. But you can either short XRT, and there's hardly any support below. So to me, if you short it and you can give it some room on your stops, it's sort of a tuck it away for now trade. If it starts to pan out, if we don't get stopped out, I'll continue to give updates and lay out some targets other than the top of that multi-year trading range. But one idea Such a beautiful name. This is ProShares. They come up with some unique names for their ETFs. EMTY is an empty, and the name of the ETF is the ProShares Decline of the Retail Store ETF. So this ETF bets on stores, retail stores that are going to fail, or or suffer from the advent and the likes of Amazon, which has pretty much been the death of a lot of retail stores. I checked through the individual charts. The first company in the top most recently reported holdings already gone to the wayside. I think they already got delisted. It's an ugly looking chart, obviously, because I just showed you retail stocks have been on fire and they're extremely overvalued. But it's a pretty looking chart. If you look at these divergences here that have been building, you have to zoom in tight. There you can see it now. Positive divergences building. Here's my levels. So this is one you can either take a hard position on or layer in, wait for additional evidence to be short the retail sector if that's your thing. And again, I'll go over the individual stocks later, but my targets, again, unadjusted, actual resistance levels. Set your limit orders to sell a little below whichever target or targets you prefer. 17, 16, 1864, 2019, and then 2264. Let's just focus on that one for now. If that is hit, that would be a 39% gain. I believe I looked into it, and I want to say this is only one-time leverage. So it's an inverse, meaning you buy this to go short a basket of retail stocks. And I could be mistaken, but I believe it's only one time. I've never used this one before and just found it. I'm trying to give you guys ideas for those of you that are unable to shorten your account, whether it's an IRA or a regular cash account instead of a margin account. So that's it. Those are the trade ideas du jour. Lumber long, bullish, oil short, airlines. Just wanted to point that out. I think there's some little more downside before they bounce, maybe quite a bit more. We'll see. Retail looking very toppy, and then finally, one stood out though among many. Target I think has a big way to fall. I don't know Target. Here's Target stock over the last couple of years, just going to the moon. I don't know. I haven't been in a Target in a long time. Maybe they changed something I wasn't aware of, but that one looks to me, among quite a few others, has a lot of hot air and a lot of downside. Not 20%, 19% to the first target, 32.5 to the next target, and then depending on when it hits this trend line, it could be good for about a 40% or so drop from where it's at now. And if you want to wait for an objective short entry, wait for this little rising wedge to break down right there. That would be your short entry on target TGT. Okay, long video, but we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.